The average senior homeowner is not losing money because they are reckless. They are losing money because the system is quiet. That is the part most people miss. A senior can pay the property tax bill on time every year, follow the rules, keep the home in good condition, avoid debt, live modestly, and still overpay by hundreds or thousands of dollars because one government form was never placed in front of them. This is why I want you to think about this differently. Property taxes are not just a bill, they are a system. And in any system, the person who understands the rules gets a very different outcome from the person who simply obeys the invoice. The average senior homeowner in this country paid about $4,271 in property taxes last year. For many of them, that number was higher than it legally needed to be, not because they cheated, not because they made a mistake, not because they were irresponsible, because a benefit already written into the law was never claimed. That is the hidden problem. There is a form that can reduce the property tax bill for senior homeowners. In many places, it is called a senior homestead exemption. In other places, it may be called a senior property tax exemption, a senior citizens homestead exemption, a senior assessment freeze, or something very close to that. The name changes by state and county. The principle is the same. The law may allow an older homeowner to reduce the taxable value of the home, freeze the assessed value, or receive a credit that lowers the bill. But the government usually does not automatically apply it. The county does not usually send a clear letter saying you turn 65. Here is the form, file it before this deadline. Attach this proof of income and claim the relief you are entitled to. That is not how the machine usually works. The machine sends the bill. It rarely sends the rescue. That is the first lesson. If you are waiting for the system to volunteer a reduction in the amount you owe, you may be waiting a long time. The ARP Foundation has reported that millions of older adults qualify for property tax relief they are entitled to by law, but only a very small percentage have applied. The numbers are shocking. Around 9.3 million older adults qualify for a reduction, and only about 8% have ever filed. That means roughly 92% may be overpaying every year. Think about what that means. This is not a small edge case. This is not one confused homeowner in one county. This is millions of people living inside homes they often worked for decades to buy, paying more property tax than they may be legally required to pay. While the form that could lower the bill sits on a county website or inside an assessor's office, that is not a math problem. That is an information problem. And information problems are some of the most expensive problems in personal finance. When people do not know a benefit exists, they do not claim it. When they do not claim it, the government keeps collecting the higher tax bill. When the government keeps collecting the higher bill, the overpayment becomes normal. Then a senior lives on fixed income, worries about groceries, insurance, medicine, utilities, and retirement savings, while leaving legal tax relief unclaimed. That is why this matters. But the situation is worse than simply not knowing. Even the people who discover the exemption often lose it, not because they do not qualify, because they file the wrong form, miss a deadline, or leave one required section incomplete. And the county usually does not fix the mistake for them. The application can be denied, the file can be closed, and the homeowner can be forced to wait another full year. This is the part of the system that is most dangerous. The benefit exists, but it has traps built around it. The senior must know the correct form. The senior must meet the deadline. The senior must attach the required documents. If the state has an income limit, the senior must prove income correctly. If there are multiple senior programs in the same county, the senior must select the right one. One missing document can cost a year, one wrong form can cost a year, one deadline missed in silence can cost a year. This is why I want to walk through it carefully. Take the example of Carol. Carol is 68 years old. She spent 26 years as a public school teacher in Illinois. She bought a home outside Springfield in 2001 for $162,000. By 2024, that home was assessed at about $310,000. Her annual property tax bill was about $7,400. Carol paid the bill every year on time. Without complaint, that is how many responsible people behave. They assume the bill is correct because it came from the government. They assume if there were a senior discount or senior benefit, someone would have told them. They assume the county would not continue charging the higher amount if a lower legal amount was available. That assumption can be very expensive. In 2024, a neighbor mentioned the senior assessment freeze. Carol had never heard of it. She went to the county assessor's website and discovered she had been eligible since 2021. That means 3 years of overpayment. 3 years where the county never warned her. 3 years where she did not know the form existed. This is not unusual. Carol is not the exception. Carol is the rule. The problem is not that seniors are lazy. The problem is that the system puts the burden on the homeowner to find a benefit that is often poorly advertised, poorly explained, and easy to lose through technical mistakes. That is why programs like the ARP Foundation's volunteer work exist. They exist because millions of people are being left behind by a system that technically offers relief but does not make that relief automatic. Now, what is the form again? The name varies by location. In many places, it is called the Senior Homestead Exemption. In Illinois, it may be called the Senior Citizens Homestead Exemption. In other states, you may see Senior Property Tax Exemption, Senior Freeze, Senior Assessment Freeze, or similar language. The exact label matters because your county may have several similar programs, but the mechanism is straightforward. Your county calculates your property tax by using the assessed value of your home. The higher the taxable assessed value, the higher the tax bill, all else equal. A senior exemption reduces the portion of the home's assessed value that is taxable if your home is assessed at $300,000 and your state or county exempts $50,000 for qualifying seniors. The tax calculation is based on $250,000 instead of $300,000. That reduced taxable value can lower the bill every year. This is not a one-time coupon. It can become an annual reduction for as long as you remain eligible, own the home, and follow the renewal rules if your county requires renewal. Some places offer an even stronger tool, the Senior Assessment Freeze. This works differently. Instead of simply reducing the assessed value by a set amount, it freezes the taxable assessed value at the level in effect. When you qualify and file, that can be powerful in areas where home values are rising. Your neighbor's assessed value may continue rising with the market. Your neighbor's property tax bill may climb, but if your assessment is frozen correctly, your taxable assessed value may be held in place depending on the program's rules. That means the savings can compound over time. This is a very important point. The Senior Assessment Freeze does not merely save money once. It can prevent future increases from hitting you in the same way they hit other homeowners. Over 5 years, 10 years, or longer, that difference can become large. Carol qualified for both the senior exemption and the assessment freeze. She did not know either existed. That is why the hidden cost was so large. Now let us talk about the money. The amount varies widely by state and county. Some programs save a few $100s per year, some can save thousands, some can freeze the assessed value and create growing savings over time, some have income limits, some have age requirements, some require annual renewal, some allow retroactive claims, some do not. This is why you cannot rely on a national answer. You must check your county. But the range can be meaningful in New Jersey. The maximum savings under a senior freeze type program can reach about $6,500 per year. In Texas, homeowners age 65 and older may receive an additional exemption amount, which can save eligible seniors roughly hundreds of dollars per year in school district taxes alone, with the source using a figure around $938 in New York. Newer legislation mentioned in the source allows localities to exempt a larger share of assessed value for qualifying seniors. In Illinois, the senior assessment freeze can lock the assessed value once the correct application is filed and approved. Now imagine the numbers over a decade. A senior saving $6,500 per year could keep $65,000 over 10 years. A senior saving close to $1,000 per year could keep nearly $10,000 over 10 years. A senior whose assessment is frozen in a rising market may save more each year, as the gap between frozen value and market-driven assessed value widens. This is why the form matters. It is not simply paperwork. It can be a financial asset. A form that legally reduces a recurring bill is economically similar to creating a small income stream. If a senior saves $1,000 per year, that is $1,000 of after-tax cash flow retained. If a senior saves $3,000 per year, that is $250 per month. If a senior saves $6,500 per year, that is more than $500 per month. For someone on Social Security or a fixed retirement income, that can be the difference between pressure and breathing room that can pay for medication, utilities, insurance, groceries, home repairs, transportation, or simply the dignity of not being squeezed so tightly by a home that was already paid for with decades of work. This is why the relief matters. Now, the retroactive angle is the part many people never see coming in some states. If you qualified in earlier years but did not file because you did not know the program existed, you may be able to submit retroactive applications for prior tax years. In the source, Texas is described as allowing up to 2 prior tax years in some circumstances. Illinois is described as allowing up to 3. In Carol S.'s situation, that meant she could try to recover overpayments for the years when she had been eligible but had not filed. That is very important. Most people assume that if they missed the form, the money is gone forever. Sometimes it is, but not always. In states and counties that allow retroactive relief, the senior may be able to submit the form for prior qualifying years and receive a credit or refund depending on the local process. This is as close as the property tax system gets to money already owed to you. No new investment, no complicated financial product. No attorney in many ordinary cases, just the correct form, the correct documents, the correct year, and the correct office. But if you do not know the retroactive rule exists, you will never ask. And if you never ask, the system will not volunteer it. That is the pattern. The benefit exists, the deadline exists. The retroactive option may exist, but silence protects the overpayment. Now, let us look at why so many eligible seniors have never filed. The first reason is that exemptions are not automatic. Most property tax systems do not automatically detect that a homeowner has turned 65 and then apply the correct senior benefit. There is usually no automatic flag that says this person may qualify. Reduce the bill. There is often no letter explaining the program. There is no default protection. You must file. That is the core design. The second reason is that the programs are fragmented. One county may have a standard homestead exemption for any homeowner. Another may have a senior homestead exemption. Another may have a senior assessment freeze. Another may have a circuit breaker credit. Another may have a veterans exemption, disability exemption, or low-income senior credit. The names sound similar. The forms may look similar. The deadlines may differ. The income limits may differ. The documents may differ. A senior can easily find the wrong form, fill it out sincerely, and still lose the benefit. The third reason is that deadlines are not obvious. The deadline is often not printed in big red letters on the property tax bill. It may be buried on a county assessor website. It may require searching the exact county and program name. It may change by state. It may differ between exemptions. Florida may have a deadline around the 1st of March for certain homestead and senior-related exemptions. New York City has a March deadline for senior citizen homeowner exemption applications. Texas often uses an April deadline for certain exemptions. Colorado may have a later summer window for senior property tax programs. The exact deadline must be confirmed locally, but the pattern is clear. If you do not know the deadline before the deadline passes, the window closes silently. The county is not waiting to remind you. The fourth reason is income proof. This is the trap I want you to pay attention to because it is one of the most common rejection points. Many senior property tax exemptions and freezes have household income limits. In the source, Illinois uses a household income threshold around $65,000 for certain senior freeze rules. New York City uses an income limit in the high $50,000 range for its senior citizen homeowner exemption. Florida's additional senior exemption uses a lower income threshold depending on the year and local rules. The exact number changes by state, county, and program. But if the program has an income limit, you usually must prove your income. That means you may need to attach a prior year tax return, Social Security award letter, pension statement, or other accepted documentation. If you submit the form without income proof, the county may not call you and ask for the missing paper. It may simply deny the application, denied, closed, wait another year. This is where people lose money even after finding the right program. They think the form itself is enough. It is not enough if the form requires documentation. The document package is part of the application. No proof of income can mean no approval. No proof of ownership can mean no approval. No proof of age can mean no approval. No proof of primary residence can mean no approval. One missing document can cost real money. This is the brutal part of bureaucratic systems. They can be technically fair and practically unforgiving. The rules may be public, but the burden is on the applicant to execute perfectly. A senior who spent 40 years working, paying taxes, raising children, and maintaining a home can lose a benefit because one income line was left unsupported. That is not a moral failure. It is a systems failure, but the systems failure still costs the homeowner money, so you must treat the application like a serious financial document, not casual paperwork. Now, let us return to the wrong form trap. Most counties run multiple property tax relief programs side by side. The senior homestead exemption may reduce taxable value by a fixed amount. The senior assessment freeze may freeze the assessed value. A circuit breaker program may reimburse or credit certain taxes based on income. A standard homestead exemption may apply to any primary residence regardless of age. These are not interchangeable. Filing the standard homestead exemption when you needed the senior freeze may not protect you. Filing the senior exemption when you also qualify for the freeze may leave money on the table. Filing the wrong program may result in denial if you do not meet that specific form. Rules. Even if you would have qualified under another program, counties generally process the application you submit. They do not always redesign your application for you. That means you need to identify every property tax relief program that applies to your situation before submitting. Not one, everyone. If you are 65 or older, own and occupy your home as your primary residence, and have income below a certain threshold, there may be several programs. You may qualify for a general homestead exemption, a senior homestead exemption, a senior freeze, a low-income senior credit, a state-level property tax circuit breaker, a local ad on exemption. You need to check them separately. This is where the money hides. People file one form and think they are done. Sometimes they are not. Now, let us make the process practical. The first thing is to confirm eligibility. Do not assume most programs require the homeowner to be at least 65 or to reach the qualifying age by a specific date. Many require the property to be the primary residence. Many require ownership. Some include surviving spouse rules. Some require a household income below a set threshold. Some require the applicant to have lived in the home for a minimum period. Some require annual renewal. Some apply automatically after approval, while others must be renewed. Your state and county decide the details. So the first action is to go directly to the official county assessor or county property appraiser website. Not a third-party site, not an advertisement, not a random lead generation website, the official government site. Search your county name plus senior homestead exemption application. Search your county name plus senior assessment freeze. Search your county name plus property tax exemption deadline. Search your state name plus senior property tax relief. Search the current year. The year matters because deadlines, income limits, and forms can change. The second action is to identify every relevant form. Do not stop after finding one. Look for the senior exemption, look for the senior freeze, look for circuit breaker credits, look for state-level property tax relief, look for county-specific local exemptions. If the names are confusing, call the county assessor's office and ask directly. Ask, I am a senior homeowner. I live in this home as my primary residence. I want to know every property tax exemption, assessment freeze, or credit I may qualify for. Which form should I file? Write down the names, write down the deadlines, write down the required documents. The third action is to gather documents before filling out the form. This is where many people fail. You may need proof of age, such as a driver's license, birth certificate, state ID, or other accepted document. You may need proof of ownership, such as a deed, mortgage statement, property tax bill, or county record. You may need proof that the home is your primary residence, such as a driver's license, address, utility bill, voter registration, or other evidence. You may need proof of household income, such as a tax return, Social Security award letter, pension statement, W-2O, 1099, interest statement, or other income documentation. If the form asks for proof, attach the proof. If the form asks for household income, do not guess casually. If the form asks whether income includes Social Security, pensions, retirement account withdrawals, dividends, interest, wages, rental income, or other categories, read carefully. Different programs define income differently. Some use federal adjusted gross income, some use gross household income, some include Social Security, some do not, some include tax-exempt interest, some include retirement distributions. This is why you must read the local instruction sheet. The fourth action is to find the deadline and create a reminder. Do not rely on memory. Write it down, put it on a calendar, set a phone reminder, tell a family member. If the deadline is the 1st of March, the 15th of March, the 30th of April, the 15th of July, or any other date, treat it as a financial deadline, not a casual date. Missing the deadline can cost a year of savings. The fifth action is to submit directly to the county office using the official process. Some counties allow online filing, some require mail, some require in-person submission, some require notarization, some require original signatures, some require supporting documents uploaded in specific formats. Follow the instructions exactly. If submitting by mail, keep copies and consider proof of mailing. If submitting online, save confirmation numbers. If submitting in person, ask for a stamped receipt or confirmation if uploading documents confirm they were received. Do not assume submission is complete until you have proof. The sixth action is to follow up. Government systems can lose paperwork, files can remain pending, applications can be incomplete. A call a week or two later can prevent surprises. Ask whether the application was received. Ask whether it is complete. Ask whether any documents are missing. Ask when approval or denial will be issued. Ask how the exemption will appear on the tax bill. This is especially important if the deadline is near and there is still time to fix a missing item. The seventh action is to ask about retroactive claims. This is critical. Ask, if I qualified in prior years but did not file, can I submit retroactive applications? How many years back? Which forms? What documents, what deadlines, how are refunds or credits handled? Do not assume the answer is no. Do not assume the answer is yes. Ask the answer can vary by state, county, and program for some seniors. This question can mean thousands of dollars. Now let us talk about why the government does not advertise this aggressively. The simple answer is incentives. A county relies on property tax revenue to fund schools, local services, public safety, infrastructure, and government operations. Every exemption reduces the taxable base or reduces revenue that would otherwise be collected. The program may be required by law, but the county does not necessarily have an incentive to make every qualifying person apply successfully. That does not mean every county employee is acting maliciously. Many county workers are helpful, many are overworked, many will answer questions honestly if you call. The issue is not individual character, the issue is system design. A system can be legal, staffed by decent people, and still produce bad outcomes for people who do not know how to navigate it. That is why I always return to principles. Do not depend on the system to optimize for you. The system has its own incentives. You need to know yours. Your incentive is to keep the money you are legally allowed to keep. That requires action. Now, for seniors and families helping seniors, this is especially important because property taxes can force people out of homes. A homeowner may have no mortgage and still struggle because property taxes, insurance, utilities, repairs, and medical costs keep rising. The home may be paid off, but the carrying costs remain. This is one of the most painful realities of retirement. Owning a home does not mean housing is free. Property tax can rise every year. Insurance can rise, maintenance can rise, utilities can rise. If income is fixed, these increases create pressure. A senior exemption or assessment freeze can reduce one of the largest controllable pressures. It can help a senior remain in the home longer. It can protect cash flow. It can reduce the need to sell. It can reduce stress. That is why this is not just a tax trick. It is a retirement security issue. Now, let us look again at Carol's case through a systems lens. Carol did what the system asked. She worked, she bought a home, she paid taxes. She stayed current, she trusted the bill, but trust without verification cost her. The county did not identify her and say, "You qualify," the neighbor did. That is an important detail. In many cases, the difference between overpaying and saving thousands is not a government notice. It is a conversation, a neighbor, a family member, a volunteer, a video, a checklist, a moment where someone says, "Did you file the senior exemption?" That means if you are watching this and you have a parent, grandparent, aunt, uncle, neighbor, or friend who owns a home and is over 65. This is not only about you. Ask them, have you filed the senior homestead exemption? Have you filed the senior assessment freeze? Does your county have an income-based senior property tax credit? Do you know the deadline? Did you attach proof of income? Have you checked whether retroactive applications are allowed? These questions can be worth real money, and many seniors will not ask them on their own because they assume someone would have told them. That assumption is the trap. Now, I want to be careful about one thing. The exact rules vary. Do not file based only on a general description. Do not assume the dollar amounts in another state apply to yours. Do not assume the income limit in Illinois applies in Florida. Do not assume a Texas rule applies in New Jersey. Do not assume New York City rules apply outside the city. Property tax is local. The rules can be state level, county level, city level, school district level, or some combination. That is why the official county assessor or property appraiser website is the starting point. The general principle is national. The form is local. That distinction matters. Now, let us talk about the income limit mistake in more detail. Many seniors assume that because their income is low, the county will know it. The county does not necessarily know it in the way the application requires. The IRS may have tax records, Social Security may have benefit records, the state may have some records. But your county exemption office usually needs the documents attached to the application. Eligibility is not enough. Documented eligibility is what gets approved. This is a major difference. You may qualify in reality and still be denied on paper because the paperwork did not prove it. That is true in many systems. Taxes, benefits, insurance, loans, government programs. What matters is not only what is true, what matters is what you can document within the rules of the process. So if the form asks for household income proof, treat that section as the highest risk part of the application. Attach the tax return if required. Attach the Social Security award letter if accepted. Attach pension statements if needed. Attach all household income documents if the rules require household income, not individual income. If married, include the spouse. If the program requires household income, if adult children live in the house, check whether their income counts. If there are retirement distributions, check how they are treated. Do not guess. Read the instruction sheet. Call if unclear. The denial letter may arrive too late to fix the mistake. Now let us also discuss renewal. Some exemptions renew automatically after initial approval. Others require annual renewal. Some require income proof every year. Some require renewal only for the freeze. Some counties send reminders, some do not. Some remove the exemption if renewal is missed. So after approval, do not assume the benefit is permanent without checking. Ask the office, does this exemption renew automatically? Do I need to file every year? Do I need to update income documents annually? What happens if my income changes? What happens if I move? What happens if the homeowner dies and a surviving spouse remains? What happens if the property is transferred into a trust? These questions matter. 1 year of approval does not always guarantee every future year. The property tax system rewards maintenance of paperwork, not only the first filing. Now, what if the application is denied? Do not assume the denial is correct. Read the reason. Was the wrong form used? Was proof of income missing? Was the deadline missed? Was ownership unclear? Was age proof missing? Was the property not listed as a primary residence? Was household income calculated differently than you expected? Was a document illegible? Was the application incomplete? Call the office. Ask whether there is an appeal process. Ask whether you can correct the missing item. Ask whether a different form applies. Ask whether there is a retroactive option. Some denials may be final for that year. Others may be fixable if caught early. The only way to know is to ask. Do not let a denial letter stop the investigation. A denial may mean you do not qualify. It may also mean the application was filed incorrectly. Those are very different. Now let us think about the broader lesson. The rich and the financially sophisticated often understand that taxes are not just something you pay. Taxes are something you manage legally. They hire accountants, they study rules, they file exemptions, they claim deductions, they structure assets, they meet deadlines, they document everything. They do not assume the first number on the bill is the final number. Many ordinary homeowners do the opposite. They receive the bill and pay it because they believe that is the responsible thing to do. Responsibility is good, but responsibility without knowledge can be expensive. The goal is not to avoid legal taxes. The goal is to avoid overpaying beyond what the law requires. That is a fair goal. If the law gives seniors property tax relief, claiming it is not greed, it is the reason the law exists. A senior who spent decades paying into the system has every right to claim the relief written into that system. Now, for younger viewers or family members, there is also a planning lesson when you age into eligibility. Do not wait. Track the age threshold before you reach it. If your state allows filing the year you turn 65, know the exact rule. If the benefit begins the year after eligibility, know that if your county requires filing by a date before your birthday, know that if you are helping a parent, do it before the deadline. This is the kind of financial housekeeping that can save more than many investment decisions. People will spend hours searching for a stock that might go up, but not 30 minutes searching for an exemption that may save money immediately. That is backwards. A dollar saved from a recurring tax bill is highly valuable. It is low risk, it is repeatable, it is legal, and it does not depend on market volatility. This is why paperwork sometimes has a higher return on time than investing research. The return on filing the correct form can be enormous compared with the effort. Now, let us imagine the full system for a senior homeowner. They own the home. They pay property tax. They reach 65. No automatic reduction appears. They continue paying. Years pass. Home values rise. The assessed value rises. The tax bill rises. Income stays fixed. The senior cuts spending. They worry. They perhaps skip repairs. They reduce medical spending. They assume this is just the cost of staying in the home. Meanwhile, a form could reduce or freeze the taxable value. That is a painful mismatch between legal rights and lived reality. Now imagine the better system. The senior or family member checks the county assessor website the year before eligibility. They identify the senior homestead exemption. They identify the assessment freeze. They identify income limits. They gather the documents they file before the deadline. They confirm receipt. They ask about retroactive relief if relevant. The exemption is approved. The tax bill falls or stops rising as quickly. Cash flow improves. That is the same homeowner, same home, same law, different outcome. The only difference is knowledge and execution. That is why I call this a systems problem. The rules are there. The person must know how to operate inside them. Now, let us go back to the beginning. The average senior homeowner pays thousands in property tax each year. Many may be paying more than legally necessary. Millions qualify for relief. Only a small percentage file. The form may be called different names. But the mechanism is similar. The exemption can reduce taxable value. The freeze can lock assessed value. The savings can range from hundreds to thousands per year. Some states may allow retroactive claims. The biggest traps are silence, deadlines, wrong forms, and missing income proof. That is the core. But the final lesson is larger. Do not confuse a bill with truth. A bill is the system's first demand. Your job is to know whether the law gives you a legal way to reduce it. For senior homeowners, this form may be one of the most important pieces of paper they never filed. And for many families, helping an older homeowner find it may be one of the easiest ways to improve retirement cash flow without asking them to work more, invest more, or take more risk. No speculation, no market timing, no new product, no sales pitch, just the correct form filed correctly with the correct documents before the deadline. That is the process the government may not tell you. The county may not remind you, the deadline may pass silently, but the relief may be there. And once you know the system, silence no longer has the same power. So check the county website, find the senior exemption, find the freeze, find the deadline, gather proof of age, proof of ownership, proof of residence, and proof of income if required. Ask about retroactive years, submit carefully, confirm receipt, follow up, and if a senior you know owns a home, ask them whether they have filed. That one question may save more money than they expect. Sometimes the most valuable financial move is not buying a stock. Sometimes it is filing the form the system never told you about.